would argue that that's not per se their policy objective, but their objective is obviously liquidity for sovereign credit markets. Federal Reserve has been engaged in a similar process lately. So we have now two reserve currencies engaged in a quantitative easing, the spirit of a quantitative easing policy. Gold hit an all-time high yesterday, which I think most people would view as a vote of no confidence against fiat currencies. I'm interested in what does that price signal tell you, and what is your view on the long-term repercussions with respect to weak currency policies? I suppose one could argue that we don't have a weak dollar because everybody else is so much weaker. But with this kind of quantitative easing policy in place, we've sort of removed one of the firewalls that have separated our monetary and fiscal policy, and that has probably changed, investor impressions and looking into the future with respect to the stability and strength of our currency. What's your view on that?
Well, the signal that gold is sending is in some ways very different from what other asset prices are sending. For example, the spread between nominal and inflation index bonds, the break-even, remains quite low, suggests that markets expect about 2% inflation over the next 10 years. Other commodity prices have fallen recently quite severely, including oil prices and food prices. So gold is out there doing something different from the rest of the commodity group. I don't fully understand the movements in the gold price, but I do think that there's a great deal of uncertainty and anxiety in financial markets right now, and some people believe that holding gold will be a hedge against the fact that they view many other investments as being risky and hard to predict at this point.
Yeah, so I think most people would agree that we don't have an inflation problem right now on our doorstep, that you could actually make an argument for disinflation or deflation as being potentially a risk. Mike, I'm curious as to what do you look at to gauge inflation? It looks like you're really on this output gap model. You're using tip spreads. You're using consumer surveys. What leading indicators do you look at to inform your view on the future possibility of inflation, and how much do you put stock in those leading indicators?
Well, you pointed to a number of them. Certainly, we look at resource utilization and price and wage pressure, which is very low right now. With the increases in productivity we're seeing, unit labor costs are actually declining, so firms are finding that their labor costs are actually falling rather than rising. Inflation expectations are very, very important, and we take some comfort from the fact that, as measured through a variety of mechanisms, they've been quite stable. And we look broadly at the economy, at commodity prices, and a variety of other indicators to see what markets are anticipating. So it's a very eclectic process. I guess what I would like to say is that even though we have indeed expanded our balance sheet, as you know and understand, I've given some testimonies in the last few months where I've laid out in some detail how we can exit from those extraordinary policies as needed, when needed, without leaving any monetary or inflationary bias in the system. So we're comfortable that we have those tools.
Right, and the new tool you have is the ability to pay interest on reserves. My concern with this tool, and I just want to get your take on this, is we're talking about a credit crunch that our constituents are facing right now, especially if you're talking about rolling over, the vintage of commercial real estate paper and the fact that people can't get their loans from their community banks. So there's a credit crunch right now. When you go in and charge interest on reserves to mop up the money supply once velocity starts, moving, it seems to me that you're just going to precipitate another credit crunch on top in order to mop up inflation. What's to make us think that we're not going to have tighter credit when the time comes around for your policy action to be reversed?
Well, Congressman, it's exactly the same situation under any monetary policy tightening. When the Federal Reserve thinks that the economy is growing more than a sustainable pace, it begins to raise interest rates precisely to reduce the demand for credit and to give an alternative to loans. And so it's just the same as in any monetary tightening.
So we're looking at a tight credit period for quite some time, it seems to me.
Well, except that the pace and degree of our tightening will depend on what we see is necessary to get the economy on a sustainable growth path.
Let's get to the growth, and this will be my last question. If my numbers are correct, we need to create, the economy needs to create 250,000 jobs per month, every month for 5 years straight if we want to get back to pre-recession unemployment levels. It's an incredible amount of job creation that's necessary. We can't keep taking the census every year. That's once every 10 years. And so as the inevitable pullback on the spending occurs, the government spending occurs, and hopefully, the kind of hiring of government workers does not keep on its pace because that involves other liabilities, do you have confidence that the private sector will pick up the slack in employment to get unemployment going down fast? 3 to 3.5% growth doesn't strike me today as sufficient enough to get back to these kinds of lower unemployment levels that we've enjoyed in this country. What's your view on that?
Congressman, as I said in my testimony, I do think that private final demand, including exports, but also consumer spending and investment, is taking the baton from fiscal policy and inventory decumulation to provide some source of growth. So in that respect, as we all would like to see, the private sector is beginning to take over this recovery. But at the same time, there's not much evidence at this point that the recovery will be robust enough, will be V-shaped enough, if you will, to get us back to historically normal levels of unemployment in a short period of time. So that is the downside and the disappointment with this recovery.
Is hitting the economy with higher tax rates on capital and income, especially for small businesses, going to help us get that growth up to where we need it to go next year?
Well, we certainly want to get small businesses healthy and hiring as much as possible. We've worked, for example, very hard on credit for small businesses, and they are an important source of job creation.